You are listening to Mining Stock Education.
Because this industry we're in is so cyclical, because investor psychology causes it to go higher than it should and lower than it should, if you're in a bull market, greed is going to be the primary driver. But when that flips over and things start to turn down and it's like the negative reinforces the negative, it's a self-fulfilling prophecy, then fear is the primary driver.
You have to be more rules-based just to cut out the emotion, because I don't think anybody truly can be 100% emotionless. It's super hard to do. And a lot of people struggle either on the buy side or the sell side. And I would say, again, most retail investors struggle on the sell side.
Well, it's our monthly Junior Mining Insights chat. I'm your host, Bill Powers, along with my co-host, Brian Leni. We're going to talk through junior mining investing, things we've observed over the past month, as well as insights and growth issues that we're considering in our own portfolio and investing approach. Brian, let's talk first regarding investor psychology. I listened to a lot of Howard Marks, the Oak Tree Capital, over the last month. Got a lot of his books, and he talked about investor psychology, and I want to throw this out to you for the starting of our discussion. And he says, changes in fundamentals do not cause changes in prices. Changes in fundamentals filtered through changes in psychology produce changes in prices. In the real world, things fluctuate between pretty good and not so hot. But in the market, things fluctuate between flawless and hopeless. And this is because of investor emotions, which cause overreactions. Now, you're a price to value guy. You like to look at a lot of the developers. What's your commentary or reflections after hearing this?
First, I think it's extremely wise. I hadn't heard or read that quote before, but he's bang on. And that's such a good way to put it. That is exactly the way it works. And I think that's how you get, discrepancies in price to value, is that, people don't want to invest or don't want to put money at risk until, basically they think there's no risk and they think things are great. And that this means sentiment change. And this is what happens in a bull market. When people think things can only go one way, and they've usually missed, unfortunately, the biggest part of the move that contrarians get to enjoy is that sentiment change. And wow, that's extremely wise, and it's something that people should keep in mind, especially in this gold bull market when things are going to get extremely frothy, I think, and you're going to have to keep your wits about you. And you sort of what we've talked about in the past, still looking to kind of disconnect yourself from the herd and, remain focused on finding value out there and not get too caught up in the momentum and remember to sell along the way. And I think what we've seen over the last week or two, maybe more people would agree with what we were saying before, maybe not.
In my approach, in this bull market, I'm trying to be more disciplined, less greedy. One of the strategies that I've employed is looking at big board US listed miners and talking to management, getting to know the story, coming to my own conclusion on value, and then watching those specifically for when the prices often drop 25 to 40% and they do a big raise. That raise is then catalytic. It raises awareness. I buy in the open market close to the raise price, and then that strategy has worked well. Like Nova Minerals, NVA on the NASDAQ, I bought under $9 at a financing. That thing hit like $80 at its peak. I sold well before then, but that was like a 3-month trade. Worked out really well. Comstock Inc., Load, another company that I got to know really well, bought that, and that was about a double in about 45 days following the same strategy. And then you can trade around. Something I haven't done in previous bull markets is trade around my positions. I know you trade around the edges of your positions more than I have. I guess I was more I understand the long-term strategy, what they're trying to do over a 2 or 3 year time frame. Therefore, I'm going to be patient and sit back and not try to trade. I'm doing a different approach this bull market too. When a stock goes up 40% on a Substack article, then I'll sell 80% of that position or even 100% of the position and then buy it back with more money when it drops 60% because people forgot why they bought it. So trading around a position is what I'm doing more. And it goes back to what Howard Marks is talking about, especially with small caps. Investor awareness and investor psychology can drive small caps more than the large caps, right? So when you understand value, you believe you have you understand the value and how that dislocates from the price because of these swings in investor awareness and psychology. That's something I'm taking advantage of more in my own portfolio this bull market than past ones.
Totally. And I think, again, that whole thesis that you have about the big boards in the US, again, we've talked about this in other conversations. I believe at Beaver Creek with David Erfley, the US market is such a big opportunity for these resource companies, especially with the US government's or the DoD's desire to start investing in these companies. And I think that the ones that are on the big boards have the wherewithal to market themselves in the US in some shape or form. I think a lot of the US investors, especially at the top end, sort of equate these things to tech. And when you start seeing tech valuations, you want to see juniors and you equate them to being volatile and have explosive moves to the upside. The tech is that probably, but on steroids. And so you mix a resource bull market with well-marketed companies that are listed on big board US. And I think you have, a very good mix of something that could really explode to the upside. And, again, I think we're just at the cusp of this thing starting, and more companies should be pursuing, I think, the US listings just for that reason, because of that exposure and what people in the US or investors in the US sort of equate junior mining or venture capital to the tech, because it can be super explosive. And I think you're doing a really smart, or have a very smart way of speculating right now.
So as I study other investors and their patterns, I can only do so to the degree that I'm willing to self-reflect on my own psychology that I bring to investing. And that brings me back to something Michael Casawan, the former broker and the current chairman of TDG Gold Corp, when I had him on the show maybe 45 days ago or so, he said when he was a broker with Sprott, actually pre-Sprott, when he was working for Rick Rule in Carlsbad, California, he said clients would resent me selling a junior too early for them, but they would forgive me for their losers. And you just interviewed Nicole Adcheed-Bell, and she referenced a study that pointed out the same thing. And so this brings up that whole greed and fear dynamic. You get angry at the broker because, are you greedy? Was he doing risk management when he sold it too early? But they'll forgive you for the mistakes. So what is your reflections on hearing this and that interplay of greed and fear? What drives us more?
They're both very hard to overcome. I would say that fear is the more potent emotion. And maybe it's because I'm using contextually fear outside of just investing, just like in life period. I think when you see the amount of people that hold back from starting a business or leaving their 9-to-5 to become an entrepreneur, or even just pursue a different job, all those different aspects on how fear really caps people in the way that they live their lives. To me, fear is the harder emotion, to overcome and to sort of heal from. but the same token, greed is what can lose you a ton of money as an investor. And I've made mistakes sort of on both ends of that spectrum. And I think, again, when you're in a bull market, usually fear is put to the wayside because greed is really driving you. And that's why you see bull markets reach those speculative or crazy tops that we eventually, I think, will. And that's when you have to have you should start having some more fear. And you can go back to those like Buffett quotes of, when everybody is jubilant, you should be fearful, and the opposite. Those hold true every time you look at it. And again, that's what you need to have at the back of your head. And I believe Rick Rule, he said another one, he's like, when I'm feeling smart is when I need to be the most reflective on what's going on, and vice versa. When you feel dumb, that's when the most opportunity is out there. So no matter how you want to spin it, it's absolutely true. But keeping that psychology and keep reminding yourself of that, it's so easy to make mistakes in this business, and it's cyclical, and the good times do end at some point. So you need to be wary of that when you're navigating it.
Okay. Tell me if you think this reflection that I have is accurate. Because this industry we're in is so cyclical, because investor psychology causes it to go higher than it should and lower than it should, if you're in a bull market, greed is going to be the primary driver. But when that flips over and things start to turn down and it's like the negative reinforces the negative, it's a self-fulfilling prophecy, then fear is the primary driver until it shifts. Do you agree with that? Like in general, it depends on where we are in the cycle to see if it's more greed driving it or fear driving it.
Totally. And you're always flip-flopping. And again, that's what sort of makes the corrections in bull markets sometimes a little more drastic than in a bear market, because there is so much jubilance. And then when things sort of, especially at the front end of this kind of switch in sentiment, when things are going really, really well, and then all of a sudden there's a drop, it's almost like that emotion just says, "Okay, I need to sell something too, because maybe this is the top." I think that's why, when they break up the cycles of a bull market, you have sort of that climbing the wall of worry and the different stuff, because you're sort of psychologically second guessing yourself of whether what you're seeing is actually correct, and whether you should be selling. And that's why I think, like, to contain a lot of those emotions, we're all human. And me, myself, like, I've used a set of rules, and it's not a piece of paper at the side of my desk anymore. It's in my head. But I think the more disconnected you are from this business, the more that you've got like a 9-to-5 job, a family, and you're doing investing on the side. I think there's more probability that you have to be more rules based just to cut out the emotion, because I don't think anybody truly can be 100% emotionless. It's super hard to do. And a lot of people struggle either on the buy side or the sell side. And I would say, again, most retail investors struggle on the sell side. They understand the need to buy things cheaply, but then you get into a bull market and it's like, well, this thing is just going to go up from here, and the gold price is going to 10,000 tomorrow, and I just need to hold. And then you get into situations, the market comes back a little bit, and then maybe you second guess yourself, and you just keep on flip-flopping. So to me, it's exactly what you're describing, and it's the constant battle, and you have to find a way to sort of deal with that.
So you know how Google profiles us, and then they market towards us because they know that what we're interested in, because it tracks all our activity across the internet. So I texted you recently, a newsletter writer, promo in order to get people to sign up for his newsletter, and he's promoting a gold pick, but in that promotion he puts at the top, like, basically, buy my subscription so you can learn about this gold pick before it's about to go 5x. And one of the things I texted to you is I was like, man, especially being a US person, you cannot promise returns, especially on the most speculative of stocks, right? So he's promising a 5x return. And, if the SEC sees that, I wouldn't want to field those emails or calls when you promise returns. Like, you can lay out an investment thesis. You can come to a conclusion of, I think it has this probability of success. You can even say it might have this valuation if they accomplish these things in this market, right? Like, but those are if-then statements. But to say, like, this is a 5-bagger, you can't promise it like that. So I guess what I'm pointing out in relationship to what we're talking about is he's marketing to greed, but he's also marketing to ignorance too, when you're promising returns on a speculative stock. Any thoughts as a fellow newsletter writer?
Yeah. I don't even know what to say. Like, I don't really have that much sensationalism in me to sort of claim something like that. So to me, it seems pretty foreign or crazy to sort of market like that. But, as we were sort of talking, is that he's doing that because it works. And it's been shown that people do respond to those sorts of claims, or the sort of pointing towards that's what it could be. And, that's why he's doing it. And, people should kind of take heed of when you read something like that. This is marketing. This is not sort of reality, even though it can be reality in a bull market, or you pick the right company. But it's certainly not the exact norm, and you're not going to have that on every single pick. You're going to have losers, and hopefully you do have some winners. For me, like, I get the legality stuff of that. I still think that people should be held to more responsibility themselves. I think you should
the individual investors you're referring to.
Yeah. Like, I get that's it's definitely not the classiest way to market yourself, but to me, I still put a lot of onus on the investor to have some common sense and say, hey, the best investors in the world don't claim these sorts of returns, and they're not into big time speculations. But even if you look at some of the most successful junior resource sector investors, none of them are talking like that. And so you'll get the mention of, I've had a few really good 10 baggers, 20 baggers, but those aren't the norm. Most of the time, most years, that is not going to be your return. And usually if you're getting that return on a company, it's an exploration company, and you're taking a huge amount of risk to attain that sort of valuation in a sort of short period of time. So like, there's so much more to it, and I get the legality side, but I just, people need to be smarter about how they view things. And that correlates to how junior companies sort of market themselves too, right? Not only newsletter writers who are talking about investing in these companies, but how the actual company, what they might be promising, how crazy or outlandish it might be. Again, the investor needs to be able to sort of weed through those and find out, the ones that are actually have, good plans and the ability to execute, whereas the ones that are just, lying to your face.
So I've talked to CEOs in private conversation of junior miners, and one of the feedbacks I gave one of them was, I don't think you're communicating the blue sky well enough. The blue sky, it's not for sure it's going to happen. However, what's the reason for a venture capitalist or a speculator to put money into your entity if you're not communicating the blue sky? And in speaking with him, I realized he was fearful of the authorities if he claimed thus and thus. And like, that's again where, you have your forward-looking statement disclaimer, usually on page 2 of every presentation. We make forward-looking statements. None of these may come to pass, right? Because it's a startup. It's an exploration project. And my advice to him was, you have your forward-looking statement disclaimer, but as you see it, with integrity, you need to more boldly lay out the what could be if you get this thing right. And that was interested. And then on the other side of the spectrum, you get guys that are like, they'll just, sell ice to an Eskimo, as they say, ice cream to an Eskimo, right? They have no integrity whatsoever. They'll tell you what you want to hear. So I've met either sides of the spectrum.
Yeah. Well, like, when I say, like, you're right. You do need to be able to sell the blue sky. You do need to be able to say what the growth or at the upside is, like, especially if you talk about the developers, right? The bull markets typically are when the developers can really shine. But people want to see how the thing is going to get bigger, or, how the company's going to grow. And so I think if you have a logical approach, you don't have to be greasy about the way you present it. Or if you're a grassroots exploration company, we've done this geochemical work. We outlined this geochemical anomaly, had such and such, gold grains, HMC samples, showed a certain amount of gold grains of pristine nature. And that means that the proximity to blah, 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 and the geophysics line up. You can see that the dispersion trail aligns with the structure, or vice versa, is perpendicular. And so, like, I think you can outline stuff. And for people that sort of know what to listen for, you can talk about blue sky, and you can do it in a very succinct manner and not be greasy about it. Like, the ones you have to watch are the ones that don't have nothing to substantiate the claims that they're making, right? Like, it only goes so far. they want to talk to you more about where the gold price is going, or where the copper price is going, or where the gold to copper or gold to silver ratio is going, rather than talk about, I've got blue sky, but talk about the gold price, or talk about something that's narrative based rather than reality. And that's usually where you can sort of find some correlation between, the guys that are just marketing experts and the guys that are actually doing real work.
Okay, Brian, on this point, you and I have corresponded when we've seen something, and we kind of profile the leaders as greasy and a project as probably not that substantive. And then they bring in some legitimate people into that. And then the discussion we have behind the scenes is like, why did that person take on that job? Or why did that person decide to work with this group? Don't they know about this? Don't they know about that? And any reflections you'd be willing to share publicly regarding some of those discussions you and I have had?
Well, it's sometimes it is a conundrum of how stuff like that comes together. I think, again, we talking about, prior monthlies, we've talked about how a scorpion is usually always a scorpion. And I haven't really found an instance where it's not that way. And I think, maybe it goes back to the greed nature of being human, and how there's some opportunities, or there's some things that happen in life, and you're more prone to do deals with the more greasy part of the sector, just because you see the opportunity, whether that's, a nice chunk of options, whether that's founder shares, whether that's, a clear indication that this story is going to be marketed a certain way, and you have some sort of way to milk those shares out into the pump. I think depending on what's going on in your life, even the good, smart people out there can be sort of warped by that. And, once you sort of get into that mode, greed can be one of those things that leads you down the wrong path. And, I've seen that in a couple instances that still sort of, perplexes me on how you get there. But, I to an extent I can see it, and it's unfortunate, but that's the way it is.
And an observation we have that we can share with listeners is that sometimes you could say a greasier group, at least as we see or profile them as greasy, they may set themselves up with 6 companies, but in order to be legitimate for the 4 pump and dumps in 2 of those companies, they need to put legitimate people there, and maybe they would even have success with that, which then they can use then to market themselves in the future. And that, that can give them legitimacy to run their pump and dump on the 4 companies, because they got real people doing things operationally or exploration wise on 2 of the companies. Any further thoughts, or did I say it?
Totally. No. That's a really good point to bring up, that you can have a suite of companies and have 1 or 2 that are the real companies, and the other ones are there just to milk the market. And again, like people need to sort of learn that from experience, of sort of what you're dealing with. But again, if you look at each company in detail on its own, you should be able to sort of weed through what's actually going on. But you can step out and say, hey, look, these are the groups that sort of always do a good job. And then there's groups that are sort of a mix, where you have to be really bang on how you're approaching your analysis of each company, because some of the stuff can be hidden. But just remember that scorpions are always scorpions, and they may try to camouflage some of it, but it always, in my experience, comes out in some shape or form.
But haven't you considered investing with a scorpion? Even when the valuation looks so low, and you said, even though he's a scorpion that knows how to finance, right? And he has developed some companies, right? So totally. But
Bill, like the last one that happened last year, it came back to bite me. I was like, you know what? I'm getting in at the same level that these guys have. And in terms of like their seed shares, and maybe not the founder shares, but the seed shares and the warrants that were out, it's like, I'm financing at the same level, really good target. And, to me, I think, why would you want to just destroy yourself? Well, no, you know what, Brian, that's not the right way to think about it, because there's another way to play this. We can just let the share price and everything just dwindle. And then we'll just do a financing at a $2 million market cap and take half the company at the lower valuation and then get to drilling it. And so, like, again, it just never ceases to amaze. And it's hard to sort of think of all the different permutations of how you can get screwed. And that's sort of when we start talking about profits and stuff we've talked about before. There are just so many ways you can lose money in the junior mining sector. You can be in a bull market and you can still end up not necessarily on the downside. That's not what I'm saying, but a lot of the value can get extracted by certain management teams, by a whole bunch of other things that can happen. And these are just, what you have to kind of have in the back of your mind. And to me is why you want to take profits when they're there, or when your investment thesis has sort of come to fruition. And you're not going to hit the tops or the bottoms, but there's just too many ways you can lose money in this business, to not be taking profits and having some plan for selling. And this topic again is another reminder of something that you need to kind of keep at the forefront of your brain, because there's just so many different permutations of how money can be sort of swindled away from you.
As the little guy retail investor, we need to think about, is management truly working for me on my behalf, or are they in it for their buddies, their fellow insiders in Vancouver, right? And so there's some financings that you and I have chatted about here recently in which we bounce that back and forth. And retail has legitimate objections, it seems, to some of these financing. One is ATEX. This is one that you looked into and talked to Dr. Nicole Adsheed-Bell about recently. What are your thoughts here? And I'll give it some context, Brian. There was a 4-year full warrant, and the share price hit $2.60 a share in early October. It peaked at $3 a share in October, and then they did this deal at $2.60, raised $96 million. I will note the share price was in an upward trajectory, and then they did the warrant at $4 per share. So this was on the up. And should investors say, wow, you just diluted me to oblivion, you gave them a full 4-year warrant, why are you doing that? Like, are you just giving this deal to your buddies, right? This is what retail might ask themselves. I know the counter argument. I guess I'll let you respond. I know the counter argument that the more of the insiders would take, probably.
Yeah, well, and the reason why I asked it to Nikki was because, my first reaction when I saw a 4-year warrant in a good company and in a copper market that seems to just be taking off, or there should be some optimism in sort of where the copper price is probably headed. How does a 4-year warrant pop out? And, it just kind of struck me. And again, you look at the people involved. Again, I'm so surprised that that's what happened. But obviously, there's something in there either we completely don't understand, or sort of maybe where you were going to go with how insiders might justify it, is that those longtime shareholders wanted it to happen, and that they wanted, I guess, the bigger chunk, or I don't know, paid for the risk that they've taken over the last bunch of years.
This would be part of the argument. It's don't just focus on the share price or even the warrant. Focus on who entered the story and their support, right? That's a argument that I hear. Do you see any validity to that? Like, if you're bringing in institutions that are going to support it, hold it, not flip the stock.
I think with a company like ATEX, for the quality of the deposit, there's still some question marks, but no, like I still don't personally buy it. Me, it's still like a sweetheart deal. But I get what you're saying. And I think in some cases you can sort of go down that line, but again, we talked about warrants and how they can absolutely destroy and cap a company. They can be very problematic. And not usually, it's basically all the time. It's the insiders are the big guys that always get access to that, right? Like general retail, unless they're doing a rights offering. I think a rights offering is a fantastic, and you're not getting a warrant with that, but I think the rights offering is the best way to raise money for a junior company, just because it rewards all of the existing shareholders, whether they're accredited or not. the ability to buy shares based on the position that they hold. I think that's an excellent way to raise money. But, you know, the brokers, the banks, and this is kind of along the lines of what Nikki was saying in the interview yesterday, was that, you know, somebody's looking to get paid. And that's usually what warrants, broker warrants, these sorts of things do, is they give that sort of in between. They give incentive to grab other investors to come into the placement, but they also give incentive to that middleman to sort of execute on the deal. And again, like, I do see both sides, but I go to the investor side because I am one. And I think it's ultimately a bad thing. And I think given the quality of ATEX and the copper market we're basically entering, I don't think it's a great deal.
All right, I'm going to play the other side just a little more here and get your response. Okay, well, retail investor, how do you think this project's going to move forward? Look at what we were able to do, $96 million cash into the till in an upward trending share price. Why are you complaining? Because if we're going to create more value, we need a lot of money to move this thing forward. Okay, point number two. Point number one. Now point number two. The warrants at $4 a share, the accelerator's at $5 a share. Okay, if we get it over $5 a share, look at the amount of money we're going to bring in. That means we're executing. That means you're at least a double from here, retail investor. And then we're going to have how much more? Over $100 million to move this thing forward continually. So what are you complaining about?
Sure. Okay. So again, I definitely have points or counterpoints to those. So first, and again, I don't know if this is absolutely true, but given the market we're in, smelter treatment charges are at or near zero. And with Grasberg going down, the perspective moving forward is that a lot of what I'm hearing from my network is that a lot of these traders for concentrate are now looking at financing projects to secure offtake into the future. And these finances, so they're going to finance the construction of a project to secure offtake, and they're going to do it at good financing terms. Does that sound like an environment that's hard to raise capital? And to me, it doesn't. And to me, when there's that much demand, especially for good concentrate, and how that trickles down to the good projects, which I would put these guys in, I still don't know how you get to that price. Now, again, I'm an outsider. I haven't heard that from a trader myself. This is in context to executives at other companies and a couple other people, investors in my network, that have said the same thing. And then to me, from the outside looking in, again, I think everything points towards this being a good copper market. So given the market cap, given where the company is in its development curve, again, I just find it hard to believe that was the best you could do. Like, again, people should listen again to what Nikki said. It's a choice that the company has, and I sort of don't buy that. And what was the second point that you made there?
The second point is, if we hit that $5 a share accelerator to bring in the $4 per share warrants, what are you complaining about? You guys are sitting on 100% gain, and we bring in over $100 million into the till to further advance this thing. So, like, quiet down.
So there's a couple. I think the accelerator doesn't really matter. I've seen enough accelerators not accelerated, because again, it goes back to the company, the executives either don't want to put the acceleration clause in because they don't want to disrupt usually their bigger shareholders. Like, if the bigger shareholders don't want it, then they just won't accelerate it. They'll put the clause in there, but it says nowhere in there that we have to do it at $5. And I've seen a number of them over the course of my investing career where the accelerator doesn't get accelerated. And I've been told, it's like, oh, well, the bigger shareholders or the lead order doesn't want the accelerator to be. Well,
I've held warrants that were deeply in the money, and I didn't want them accelerated either. I wanted my time value. But,
totally.
So I understand, but yeah, go ahead.
Yeah. So like the accelerator, to me, it can mean something, but again, I still refer back to the first point, and is that to this environment and for the quality of the project, to me, it still doesn't doesn't line up. And then the second part is I've seen enough accelerator clauses not actually used, and the verbiage shows you that it doesn't have to be used. It's up to management's discretion. It's there if they want it to be.
But the warrant itself, it's 60% higher than the current share price, right? So then management says, if we execute to that degree and add that much value to the story, like, you guys are fine. And then we're going to be financed. And we're not going to have to pay brokers fees like we are on this finance.
Right. And I still go back to the fact that I still don't think it's a great deal for existing shareholders. And again, rights offerings, that's something that I think more companies should be looking at in terms of rewarding existing shareholders across the spectrum, because the big guys get a chance to execute and, and depending on how you have it set up, make a meaningful contribution to the position they already have. And it gives the regular retail investor the ability to be a part of that upside.
And with the rights offering, for those that don't understand, if you own shares, you can have the right to purchase the same amount of shares to keep your percentage of the company, because these are non-cash flowing entities that require cash.
Not always. And it's not always set up directly to mitigate. There can be different ratios within that rights offering, but yeah, like, that's the basic premise, is that you can participate. You have the ability to participate, given the amount of shares that you own. And again, there's nothing that blocks an unaccredited investor from participating in a rights offering, which I think is excellent.
All right, the second one, let's talk about NexMetals. This company traded over $8 a share a couple weeks ago. It hit $12 a share in July. They did a private placement at $5.70 per unit. It was announced at 65 million Canadian it would be, but they upsized it to 80 million Canadian due to strong demand from institutional investors, representing the second time the offering has been upsized. What do you think of this?
It's a tough one. It's a company that I was doing work on and was very close to sort of executing on, because I see the upside in the projects. But, this kind of deal for existing shareholders that have been there from the premium nickel and the various name changes that they've had, I can see how they're upset. They've now been diluted massively. And again, in a copper price or copper market environment that we're in, I think it's along the same lines as ATEX, where did you really have to give a full warrant or any warrant at all to raise the money? To me, I saw the delta between price and value there. It was pretty evident, and the share price, I think that's probably maybe the biggest, not only the dilution, which I totally get, but you look at the share price was going up, and within, I don't know, a week, it's dropped down to basically where the financing was at. And then the warrant is basically placed at where it was trading just a week or two ago. Like it just does not, optically, it does not look good. And for me, that I know a couple existing shareholders, sort of that had influenced me to take a deeper look at it. Again, it's tough to swallow.
And that was I should note, that was a full warrant you're referring to, and they could acquire another share at $8 per share, which is the point you just made. It was just trading at $8 a share a couple weeks ago. Yeah.
Like that's like, I don't know what to say. I can see why people are upset, but I can also see why they upsize it, because anybody on the outside that was looking at it and saw the differential, you're like, oh, I totally see the upside potential. But, you just skewered existing shareholders that have been there for a number of years now. Plus, I would say that, that sort of move, if there's mistrust, I get why there's mistrust. Like it's having the warrant, especially where it is, and it being a full one, man, like it just doesn't seem right.
Okay. When I've talked to executives after like a deal like this is announced, maybe not this exact dynamic, but something close to it, they'll say, well, Bill, what I can't tell the market and what people can't see is that I was working on this financing for months. We agreed on a price, 45 days ago. We just had the lawyers or whatever the exchange took some more time, And so the price and my share price ran up in the meantime, but I was locked into this deal. So have you ever been told something like that?
Sure. And it might be a real thing. I don't know. I feel like, especially when you have good projects, and you have a good market and you've got a plan, I just think that the companies have more power than they sort of telegraph. And maybe there's something in my understanding that blocks me from fully getting that. And maybe that's fully justifiable. And maybe you need somebody that's both an investor and an executive to give you a more concise answer on that. But I guess I'm always looking at it from the investor standpoint. I do try to understand the companies, and it's easier for me to understand when it's people that I know. But I can't recall it having this sort of issue with people that I know. That's like this crazy. Like you can definitely see 10% differences. And I think the big thing with this is the warrant, right? Like it's one thing for when you talk about the actual price of the financing and blah, blah, blah. But when you have this dynamic where you've got the discrepancy between the price of the shares and then the warrant being basically where it was a week ago, I think that's what's problematic. Like that's a huge differential. Yeah.
So probe mining was a big win for you and your subscribers. There was a recent announcement that Fresnillo is looking to buy them or is going to buy them. Your commentary here as a former probe owner?
Yeah, I think it's fantastic. I think the fact that Fresnillo is the one that bought them is the craziest thing. I would never have guessed that's who would have bought it. I thought you were going to see more consolidation in that Val-d'Or region from maybe Agnico, but Agnico usually comes in, after a bid has already been placed in. And from what I've heard about the probe process is that it was like a sort of not a closed bidding process, but they were accepting offers and then sort of breaking it down from there. So which that seems to be counter to how Agnico works. And so like, I'm still surprised that that's how it ended up being. But good for them. I think they got a good deposit. It's got good size. And it's gold. So it's a little bit different for Fresnillo. But they obviously, it's a step outside Mexico. It's into Canada. Canada has its own risks, but it's certainly different than Mexico in a lot of ways. So it's great. And what I'll just clarify. So in the newsletter and in the portfolio, we owned Probe up to a couple of years ago, and we sold it, made really good money. So I'm talking about this outside of the portfolio. We didn't own it right now and won't capture whatever that little differential is, but we did exceptionally well on it. And I'm a big fan of David Palmer, and these guys did a fantastic job. And I guess they're on to their next deal. So that's good.
Brian, you have some non-consensus views. One of them is on the gold and silver ratio. And in a recent conversation, you basically said it's meaningless to me. And then I was saying, well, Brian, like, look at the gold and silver ratio. 2020 gets to be like 125 to 1, and then silver goes on a run. And you could see at the peak of bull markets, maybe it goes down to about 30 or 40 to 1. I said, can't you just look at that for like a reversion to mean trade? And you basically said, no, I just think it's meaningless. Can you explain to the listeners why you think that? Because some people will not agree with you.
Yeah, I know. Not very popular.
Yeah.
So I think there's a number of standpoints. I think the first one to sort of talk about is the disconnect between whatever your thesis is on metal price appreciation or depreciation and equities. There's a huge difference. And to me, as an investor or speculator in the resource sector, the first thing you need to do, in my opinion, is separate the two. You don't buy the junior equities solely because you think metal price is going to go up. We talked earlier in this conversation about how there are so many different ways that you can lose money related to a junior, whether that's, there's their political risk, there's geological risk, whether it's exploration or whatever. You can lose that on the geological side of things. You can lose that on the capital markets. You can be diluted. You can have, these warrant overhangs. You can have overspends on G&A. There's just so many different ways you can lose money in a junior equity. And so trying to correlate between metal price and owning an equity, to me, is problematic. Second, when it comes to guessing where metal prices are headed, the best commodities traders in the world hedge their bets. These are the guys with the most information about where things are headed and what the fundamentals look on both sides. And thus, with these guys, I guarantee you, they do not care what the gold to silver ratio is, what the gold to copper ratio is, what the gold to oil ratio is. They are basing stuff on real factors, and they're sort of going ahead of that. Thirdly, I think a lot of these ratios are based purely off marketing narrative. Narrative sells. You want to talk about tapping into greed. When you start talking about these sort of obscure ratios that, to me, don't have direct correlation, or they don't have direct causation in terms of why one goes up or the other goes up. Like, silver doesn't go up because just the ratio. Now, there's probably a certain amount of people that buy it just because the gold to silver ratio is off, or whatever that means. But to me, that's the minority. Most people are buying silver because of, the direct things that affect the silver market. And that's, to me, makes the most sense. Like, you buy silver because of how the silver market works, not because of its relation to gold or any other metal. Second, when you take something, or this is like fourth point, when you look at something like gold doesn't trade, or its price appreciation or depreciation has nothing to do with fundamentals. All the gold that basically has ever been mined still exists, and it sits in people's safes. It sits in safety deposit boxes, and usually the big trades or the big movements are based off, how central banks or how the big guys are really pushing stuff around or playing with the paper market, these sorts of things. And so what I'm trying to say is, like, you have a couple metals that don't have fundamentals that line up, and you want to talk about silver in particular, and that's probably where I'm going to get the most hate mail is silver has a huge component that's industrial. And the longer that I've been an investor in this sector, the more the industrial component of the silver price has become more significant. Therefore, you have gold, which is a full monetary metal, silver, which is drastically smaller, but you've got, solar cells, you've got jewelry, you've got a whole bunch of other aspects that drive the silver price and really affect why the silver price is going up and down. And to me, again, there's no correlation. And the biggest one that I see today, and it's the one that's sort of spurred in my head, was people are talking about the gold to copper ratio. Again, to me, I don't know any correlation that with the two. They're so different. You can draw this thing up, but to me, it's always to sell something. It's not based off of any fundamental thing. And again,
so this is what I think is the weakest argument, or perhaps what you're missing out of what you shared. And I'll reflect more on it. I think you've thought more about this than I have. However, I've experienced the gold and silver ratio now since I started buying gold, physical gold, back in 2012. And so I've seen how the price of gold and silver have tracked that ratio. And you're referencing silver as an industrial metal, but is it an industrial metal or is it a monetary metal? It's an industrial metal most of the time, but when it's a monetary metal, it starts to perform differently, and then perhaps it's more correlated to gold at that time. And that is where, when the gold price starts to rise and the gold to silver ratio gets to be 125 instead of 75 to 1, that at that point, it begins to indicate, okay, silver is going to operate more like a monetary metal, and therefore it plays the catch-up game. So I guess that would be the one weakness or perhaps oversight I see in what you're sharing, is that silver does function as a monetary metal. In that regard, it's correlated to gold. And when it plays catch up, it usually moves to the rate of 3 times what gold moves. That's my counter argument, or counter thought at this point.
Okay. I view things differently, and I just would never make a decision based off of a random ratio, because I think you can make gold, or you compare anything to anything and follow it over time and come up with some sort of distant correlation between the two, yet they seemingly don't have anything to do with one another. Outside of, there is a core bunch of people that do believe that and do trade, or I hope they're not buying equities and sort of buying and selling them according to that ratio. And then that becomes a big problem to me in terms of how people could lose money in the future. Because if you're waiting for the gold to silver ratio to drop down to, I don't know what the lowest I've heard is, like 12-1 or something, like natural ratio or something that people have tried to put out there. But if you're waiting for that and you're holding an equity, I think it could be really problematic, because there's, again, so many ways you can lose money, and the equities are a totally different beast. And if you're a commodities trader, if you're trading gold and silver and you've got some way to trade based on that ratio, then good for you. But to me, this stuff is mostly marketing. It's mostly to incite some sort of greed, because you can really paint a picture, talking about like the natural concentration of silver in the Earth's crust compared to gold and blah, blah, blah. Then people forget about metallurgy. They forget about, silver being, primarily a byproduct in most deposits, which affects its recovery and blah, blah, blah. And so again, like, I think you get into the weeds too much with that sort of thing. And it's more narrative based than it is, used for investing. But again, that's my opinion. I know it's not popular.
Any other things you've been thinking about the last month, Brian, that you'd like to discuss or share?
Well, I think, what about this? Like, one of the things that I've been playing with, and it's because I've seen at least one of my investment theses from the last probably 2 years just seemingly is taking forever to come to fruition. And I know I have to be patient, and I know I have got a much longer timeline for my investments to come true. But to me, all the data, and then maybe this goes back to Howard Marks, how we started off the conversation, in sort of when you see fundamentals coming together, and the market in this case is sort of reacting, but it's more that a deal isn't being made. And yet I think there's every reason why it should be. And so, I don't know what that other adage is like the market can remain irrational longer than most can remain solvent. And that's not really pertinent to what I'm referring to in the deal I'm talking about, but it's probably something that's pertinent to the whole topic. So what about you? Like, what's too long to wait for an investment to come to fruition, especially with the setting that we're in a bull market, things are moving fast. How long are you willing to wait? So
I have a shorter leash, because, though, this is the whole know thyself, understand your own psychology, because in 2022, in 2023, after having some nice wins in 2020 and 2021, I got a little loose with my money. I wrote some big checks into illiquid and private entities, and that money has just been held up, inaccessible, not capable of being liquidated. So in regards to that, and these are speculative ventures, mind you, non-cash flowing entities. So I've been a little reactive. I shared at the outset how I had some nice trades, a nice 90-day trade, a nice 45-day trades on the major exchanges in mining stocks. And so, I have a little shorter lease in that regard, Brian. I guess I would say that I'm trading a little more. I'm capturing profits when they're there. I'm a lot more hesitant to just write a nice check and have it locked up with this big hold. And for me, as you know, if I do a private placement as a U.S. investor, I have the legend. The stock could be with the transfer agent, and I may have a difficult time depositing that in my brokerage account within a reasonable time frame. So, my lease is shorter. But then, as you always point out in your nuanced answers, it depends on who you're entrusting, what leader you're entrusting this with. And if you're communicating with them, and when it comes to a deal being done, if there's too many lawyers involved, a lot of times things take longer. Or if the other side is not being reasonable from your perspective, things take longer. And then so you're balancing that with the opportunity cost, which you've referenced in the market. You're like, and so I would just say in that case, you just always say, is there ego at play? Is there reputation? Because in your case, you go on other shows as well and talk about some of your positions. Am I holding on to this just because I've mentioned it publicly? If that's the case, then maybe sell if that's the only reason why you're holding on to it. Or do you still believe that there's with the transaction that you expect, is there enough of a premium that you think management will be able to eke out for you too? And, that's how I would look at that. Understanding myself, Brian, I have a shorter lease, but at the same time, I've held Copernico Metals, one of my sponsors, since 2018. And that's been held up because of permits in Peru and getting community access, and things just move very slow on big projects. So I have held some. That's my longest held junior mining stock. The other ones, usually when I buy like a pre-production story, I have a 3-year time frame. Sometimes they work out, sometimes they don't. And then I de-risk, usually after a triple is how I've done that in terms of getting my initial capital back on those stories.
That's good. That's good.
And everybody has to figure out how to play the game in their own way. And that's something, even as I've looked at my own psychology and how I'm approaching this bull cycle, this up cycle, you really want to be in tune with how you approach. What are your strengths and weaknesses? Do you like early stage projects? Do you like pre-discovery hole, post-discovery hole? Do you like developers? Do you like producers, royalty companies? Know what you're good at, because analyzing each of those different genres of companies, it takes a different skill set. And do you know how to mix the ingredients together with the right balance of risk and reward, and maybe having some explorers, some developers, some producers, and maybe a royalty company or so? Come up with your own. Don't just mimic somebody else. Don't just follow blindly. I call them spreadsheet investors, to where the analysis of a company is only done on a spreadsheet. There's not much more of a deeper dive than that. I wouldn't recommend copying any one individual in all of their picks. Truly have an understanding of why you're buying what you're buying, and have an exit plan, which is what you always teach too, right, Brian? Every time you buy a stock, you have a sell point in mind. That sell point might move up or down too, right? Depending on how things go, but you have to have that in mind.
Totally. It's so important.
Yep.
Selling is just as important as buying.
Yes.
And especially no matter what market you're in, it matters. So you need the wherewithal and the plan to sort of execute when the opportunity is there. And the bull market's going to give you plenty of opportunity to sell. It's just whether you'll be able to do it.
Excellent. Well, we appreciate your listenership. Thanks for listening to another Junior Mining Insights chat with myself and Brian, and we'll catch you on the next show.